Hello, hello. What is up? Good morning, YouTube. Happy Wednesday, August 2nd. And some of the sell side has indeed started. If you guys were watching yesterday, what we were talking about, but it is based on some news from the overnight session. A deal over the debt ceiling was reached just over 2 months ago, but the political dysfunction in Washington and the growing debt burden still seems to be a concern. Fitch ratings have downgraded the US's long-term rating to AA plus from AAA, echoing a move made by the S&P Global Ratings, which cut its rating for the U.S. So in 2011, after a different government standoff, Fitch had placed America's sovereign status on watch negative back in May. So, but the bipartisan agreement to suspend the debt limit until January 2025 wasn't enough to claim its fears. The repeated debt limit political standoffs and last minute resolutions have eroded confidence in the fiscal matter, according to Fitch. So, in addition, the government lacks a medium term fiscal framework, unlike most peers, and has a complex budgeting process. And the general government debt to GDP ratio is projected to rise over the forecasted period, reaching 118.4% by 2025. These factors, along with several economic shocks, as well as tax cuts and new spending initiatives, have contributed to successive debt increase over the last decade. So that's what Fitch had. Treasury Secretary Janet Yellen said that she strongly disagreed with the downgrade, calling it arbitrary, and in saying that Fitch relied on outdated data. Many of the measures that the rating companies uses, including those related to governance, have shown improvement over the course of the administration with the passage of bipartisan legislation to address the debt limit, invest in infrastructure, and make other investments in America's competitiveness, she declared. Stock futures declined following the Fitch decision, while yields were volatile as investors assess the outlook of the $25 trillion global treasury market. So it was about 2 weeks ago that President Biden created a term to assess ways to avert future standoffs over the country's debt limit. Now that the latest debt ceiling crisis is behind us, it is necessary to explore all legal and political options to prevent Congress from ever again holding hostage the full faith of the credit of the United States. So we did see downside in this, right? The downside move here, a lot of it has been erased overall. I don't know where we currently stand right now, to be honest with you guys, but there was a significant downward play based on the ES that dropped into our beloved mid 50 area, which saw about a 25-point pop from that level. Right now, we're still holding off. We're hovering into those mid to low 70s, and we'll talk about a trade plan as what would be expected if this was actually a bearish turn and what a real sell-off would look like. We also have jolts, right? The U.S. Labor market appears to be cooling, albeit at a slower pace, as wage pressures subside, which could bode well for the Federal Reserve's fight against inflation. So job openings fell to 9.582 million in June compared to 9.65 million expected, marking the lowest level in over 2 years. The hires rate was little changed at 3.8%, the lowest since the pandemic started, while the quits rate slipped to 2.4%. On the other hand, ISM manufacturing remained in contraction territory for the 9 straight months. So this is not supportive of the reacceleration in earnings growth that many equity investors are anticipating, said Interactive Broker senior economist Jose Torres. So there was decent downside pressure. Even yesterday, there was a decent offer that held out in the market that pushed prices slightly lower, right? Into the opening of the overnight session, we saw that actually accelerate based on the news that came out. We still have earnings. I know that earnings might be overshadowed by this general news, and I still think seasonally we are in an area where we do see a little more downside pressure. Something else in terms of oil, right? The U.S. government has withdrawn its offer to buy 6 million barrels of oil from the Strategic Petroleum Reserve as crude prices continue to rise amid tighter supplies. So this is another thing. That crude oil does have the anticipation to see a little bearish run over the next few weeks here before I think we do see a bottoming for the foreseeable future for the next few quarters, actually. The Biden administration had released a record 180 million barrels from the SPR in 2022 to rein in surging gas prices and said it would replenish the reserve once the costs got to or below $67 to $72 per barrel. But the US crude prices just saw their best monthly gain in over a year and will likely rise further on the account of fresh production cuts by Saudi Arabia and Russia. Moreover, the latest data showed a draw of 15.4 million barrels of oil in the US commercial stockpiles for the week ending July 28th. Pre-market here, a lot of assets are down. Today, what we got going on, let's take a look at what the potential trade plan is. My trade plan is fairly simple on the day if we take a look at what is going on. Very simple in the sense that if the market holds an offer under 45.72, that makes it for a real potential sell. There is a huge bid over the past few tests of around 45.55-ish area. Massive bid that pops up like 30 points from these lows this time around. I think the real last chance is 45.80 for the offers to come in on the S&P 100 futures, but I'm not going to be holding my breath necessarily to see crazy offers because the market has been bidding really aggressively over multiple sessions. So what I'll be looking for realistically to see is if the offer can come in at 80, if the offer can come in at 72, but you start getting above 80, you start moving back into a distribution block that accepts to the upside, which just holds the idea that there's a continuous bid and that we have just continuous bidding with higher floors in the market that could see some continued upside. Seasonally speaking, we should be dropping over the course of the next 2 weeks. So I'm going to see if the offer happens, but sellers need under 45.55. That's it, right? That's the key area, under 45.55. We can close under that area or open under that area in the coming sessions. That's going to mark some more of the sell-off. My target, again, for the end of the week, very conservatively for the sellers, is 4,500. We'll see how that pans out. We got 2 more days. So with that being said, let's open up our live trading room. I'll see you all there. And take care, everyone. Have a good trading day. Have a more risk-tolerant trading day because we haven't seen too much movement. Today has the potential, with all that volume coming into the morning session, we could see some more movement. But generally speaking, very slow market conditions as we enter summer periods. So thank you all. Enjoy, and I'll see you guys soon.